Should you buy ExxonMobil? Or should you buy Chevron stock? By the end of the video you will have a better idea if to buy, hold, or sell. Support the channel. Links in the description below. Like and subscribe. Thank you so much. Chevron. Bulls say. Chevron has accumulated U.S. unconventional acreage through smaller deals in higher quality plays like the Permian and Marcellus, thus avoiding overpaying and destroying value like many peers. Chevron should realize improved downstream earnings and returns as conditions in its California refineries improve and new chemical production capacity is added via its CP Chem joint venture. Growth is expected to accelerate beyond 2021 as Permian production could double while expansion at Tengiz and Newcomb projects add volumes. Bears say. Chevron has a smaller downstream footprint than many of its peers, leaving it more exposed to downward fluctuations in oil and natural gas prices. The completion of Gorgon and Wheatstone significantly increased Chevron's exposure to LNG at a time when growing supply in the market could depress prices for several years. Chevron's focus on the Permian for growth could leave it exposed to cost inflation, given the high levels of activity in the region relative to other basins. Alternatively, it had a high decline asset that requires high levels of reinvestment. Analyst ratings. Buy, 65%. Hold, 31%. Sell, 4%. Market cap, $142 billion. Average volume, 13 million. Dividend yield, 6.84%. Get free stock up to $1,600 with Webull. ExxonMobil. Bulls say. Exxon will see its portfolio mix shift to liquids pricing as gas volumes decline and new oil and liquefied natural gas projects start production. Cash margins should improve as a result. Exxon is separating itself from peers that are focused on cash returns to shareholders by increasing investment with the goal of doubling earnings and cash flow by 2025. With coordination between upstream and downstream operations, as well as integrated refining and chemical facilities, Exxon achieves a high level of integration that creates value, as opposed to simply owning the assets, as peers do. Bears say. Investors must wait for Exxon's increased investment to pay off while knowing integrated oils have historically struggled to deliver on long-dated growth targets. Returns are unlikely to ever reach historical levels without higher commodity prices, potentially resulting in compression of Exxon's premium multiple. Dividend growth will likely slow or cease in the near term as a deterioration in commodity prices and margins and elevated spending pressures free cash flow. Analyst ratings. Buy, 15%. Hold, 69%. Sell, 15%. Market cap, $146 billion. Average volume, 29 million. Dividend yield, 10%. As always, be sure to let me know your thoughts down in the comments. Be sure to smash that like button. Thank you so much for tuning in, and I will catch you in the next video.